Hello and welcome to another informational video for Closed-End Fund Mastery. In today's video, the headline is going to be our comparison of the funds GOF and PDI using the Closed-End Fund Mastery Fund Comparison and Fund Stats tool. But before we get into the juicy stuff, let's quickly go over what Closed-End Fund Mastery is. Closed-End Fund Mastery focuses on three primary goals. 1, distribution sustainability. 2, long-term appreciation potential. And finally, being well positioned for future distribution increases and special distributions. For our main goal, number 1, distribution sustainability, for the current year to date, of the 326 closed-end high-yield funds we cover, there has already been 250 distribution cuts. 248 of those were non-CEF Mastery qualifying funds, and only 2 so far this year for closed-end fund mastery qualifying funds, for a success rate of only 0.80% of all distribution cuts for the year. Goal number 2, long-term appreciation potential. The 3-year average annual return, the 5-year annual average, and for the 5-year long-term NAV price change. This is the actual share price increase or decline from 5 years ago. Now, before we get to GOF and PDI, you can see I have a couple things to go over before we get there. First is a new feature added to Closed-End Fund Mastery, which is my new heat map. And then I'll give you a brief overview of the Super Screener. And now for the latest addition to Closed-End Fund Mastery is the Closed-End Fund Mastery Heat Map. The Closed-End Fund Mastery Heat Map tracks the net asset value performance change since the fund last reported. What's so significant about what this heat map indicates is how well a fund's net asset value performance has performed since it last reported. And this is the fund's net asset value price. It's not the fund's market price. Every day, a fund publishes a daily net asset value. So basically what you're looking at is the end effect to date of the fund's performance of assets versus liabilities, plus a fund's earned income and funds raised minus its expenses, share buybacks, and distributions. Now, if anything that jumps out at you on the heat map doesn't appeal to you and you would prefer to search for your own gems, that's when the Super Screener would come in. With the Super Screener, you could locate, sort funds based on multiple criteria, or you can use the built-in filter features to locate any particular fund by any particular criteria that you want. But we're not here to talk about the Super Screener. So if I did my job right, you should see a link hovering at the top of the screen that will take you to an in-depth tutorial of the Super Screener. And if I did not do my job correctly, there will be a link down in the description below titled "What Makes the Closed-End Fund Mastery Super Screener So Super." And now for the reason we're all really here, the comparison of the funds GOF and PDI. And just to make things a little bit more interesting, we're also going to take a quick glance at the funds PHK and PDO. Right now we're at the fund comparison tool. This is the screen you would go to compare all the funds that you screened for back on the Super Screener. Since we already know the funds we're interested in, we went ahead and entered them onto the fund comparison tool. And basically what we're going to do is look at several factors that may determine which fund has a clear edge over the others. The fund comparison tool is broken into 2 components: a fund's reported performance and its current estimated performance. All of the fund's reported fund performance are listed under the blue table headers. The current estimated fund performance information is listed under the green table headers. The gray headers list a fund's reported performance for the 3-year and the 5-year net asset value return. And these numbers are reported by the fund, and they assume that all distributions are reinvested. Column next to it, under the gray header, the long-term NAV price change, is the percentage change of a fund's actual price, not market price, NAV price, for 5 years. Unless the fund is younger than 5 years old, then it is percentage change to date for the life of the fund. For example, the fund PDO, you can see that it has no 3-year NAV return or 5-year NAV return, meaning the fund is less than 5 years old. So however old the fund is currently, its long-term NAV price change life to date is negative 40.40%. Now, before we go any further, I want to point out that as we go along, if you're not familiar with closed-end fund mastery, you're naturally going to have questions behind the numbers. And I want to let you know now that if you have any further questions, I have to refer you to the super screener video I mentioned earlier, where I go in detail about the explanations about everything on this in these numbers. But for today, we're strictly here for the purpose of fund comparison. So continuing on, next we have the fund's report date. You can see GOF reported in May of 23. The 3 PIMCO funds recently reported in June of 2023. So there's not much time difference between all of these funds. So as far as time frames concerned, we're pretty much comparing apples to apples. Next to that, we have a fund's score. And even though we're not going into what's behind the numbers in the score, I think we can all agree at this moment that 7 is higher than the other 3 scores. So up to this point, we have our first clear advantage of one fund over the others, and that is the fund's score. We have the ending NAV. That's really just a number. It doesn't really mean that much until you're comparing it to the NAV at a different time period, which we'll look at later when we get to the current performance. After that, we have the discount premium. And here we have distinction number 2. The fund PDO, that's less than 5 years old, is trading much cheaper than the other funds. Next, we have the portfolio turnover rate. In the column next to that, we have the fund's debt to equity ratio. And the clear distinction here is that the fund's GOF and PHK carry a lot less debt than PDI and PDO. In the next 3 columns, we have the income to distribution percentages. In other words, what percentage of each category type covered what percentage of the distribution for the last reported period. Under net investment income to distribution, you can see that none of these funds covered 100% of their distribution purely with net investment income. Now, this statistic might surprise you, but of the 326 high-yield funds covered by closed-end fund mastery, and this number has been consistent in market upturns and downturns, only around 10% of all closed-end funds cover their distributions purely with net investment income only. In the column next to that, you have the net investment income plus realized gains to distribution. Another interesting statistic is that between 11 and 14% of funds cover their distributions for the periods with the combination of net investment income and realized gains. And the reason for that is because the vast majority of closed-end funds, 85% and higher, rely on the unrealized portion of their portfolio to support their distributions. However, in this case, you can see that PHK was, in fact, one of the 14% or less that was able to cover their distributions with the combination of net investment income and realized gains. But then we get to the all reported income to distribution, which is the combination of net investment income, realized and unrealized gains. And you can see that number falls back down to 58%, which is 42% shy of covering the amount of their distributions for the period. However, it is still higher than all the others, so we have another clear distinction. Next is the distribution yield to NAV. Now, ideally, you want your payout to be as big as possible, but you want that payout to be as small a percentage as possible in relation to the fund's net asset value. For example, here PDO has a distribution yield to net asset value of 19.6%. That means the money they paid out represented 19.6% of the fund's total value for that period. PHK came in with the lowest at 12.2%, so that's another distinction in its favor. Next is the all reported income to net asset value. Here you want this number to be higher than the distribution yield to net asset value. For example, PDI has a reported income to NAV of only 3.6%, but it paid out 17.6% to NAV, leaving a income deficit of 14%, negative 14%. Unlike PHK, which had a 7.1% reported income to NAV, which was still 5.1% below the distribution yield to NAV, but still higher than the rest. So there's another positive distinction for PHK. Next, we're looking at the return of capital percentage of distribution. For all the PIMCO funds, they come in at 0%, so they're all a wash. A fund returning capital to their unit holders or shareholders is a good thing. It allows the investor to receive tax-deferred income from the fund, which could reduce their tax liability come tax time. But 57%, as in the case for GOF, is extreme. So in this category, GOF is the loser, and there's no distinct winner among the other three PIMCO funds. Column next to it is the annual average return of capital percentage. And for GOF, it's still a very high 43% on average. Now, if a fund has a bad period, which all funds will at one point or another, being forced to pay a 57% or even a 100% return on capital percentage for the period could be tolerated. But consistently paying out huge sums of ROC year after year, you got to wonder why that distribution isn't being cut yet. Now, I just mentioned that paying out ROC could be a good thing, but it doesn't necessarily mean that paying zero ROC is a bad thing, as in the case of PDO. PDI has an annual average ROC percentage of 1%. To that, I would have to ask, why bother? Similarly with PHK, 9% is practically nothing. Nonetheless, 9% is better than nothing, so we have another stat that goes in PHK's favor. These next two are huge: the earnings surplus deficit and the monthly distributions available. The earnings surplus deficit, when this figure is above zero, you have an earnings surplus. When you have a number below zero, you have an earnings deficit. I don't think I need to tell you which condition is most favorable. The monthly distributions available is the earnings surplus deficit converted into its monthly distribution equivalent. For example, for GOF, you have the earnings surplus deficit of negative 13%, which equates to a whole of a negative 11 monthly distributions. And the situation's more severe with the PIMCO funds, averaging around 30+% each and creating a huge monthly distribution available deficit. None of these are good, but GOF is the least worse. So GOF gets the win in that category. Next, we're going to move on to the current performance estimate. I don't think that the NAV percentage change needs much of an explanation in this case. By a slim margin, PHK is the winner. Now, the current discount premium, I know some people are of the mindset that if a fund carries a premium, that there may be some added value to that fund to justify the premium. And I've actually done a test on this particular topic, and there appeared to be no clear advantage either way. However, closed-end fund mastery actually views discounts to be more favorable, and the bigger the discount, the better, on the condition that other criteria are met, which are too numerous to go into in this video. So we're going to leave that for another day. However, as I stated, because closed-end fund mastery does consider the discount to be the better option, PHK ties with PDO. And again, because closed-end fund mastery considers a discounted fund provided other conditions are met, most favorable, then an acceleration in the discount premium is considered a positive. So when you look at the discount premium percentage change and you see that the biggest decrease in the premium is 12.9%, that also goes to PHK. Next is current yield. Here, obviously, the bigger the yield, the better. However, not necessarily so when the yield isn't even being covered, as is the case with all four funds. So there's no clear winner here in the yield portion. The estimated distribution to NAV is very similar to the distribution yield to NAV. You want this number as low as possible because it represents a smaller percentage of the fund's total net asset value. And currently, the winner here, no surprise, appears to be PHK, with the yield only representing 12.6% of the fund's estimated distribution yield to NAV. After that is the estimated income gains to distribution. Normally, you would like to see this number shaded white or green, but as it stands currently, these four funds have a deficit to the current distribution, and this is estimate only, of negative 44.9 all the way up negative 62%. So GOF takes this category, but it's not a prize worth bragging about. Next is the estimated debt to equity, which clearly favors GOF and PHK. GOF taking the lead by only 0.9%. So there's not much to brag about there. However, that's another stat in GOF's favor. Now, the estimated monthly distributions remaining. Because of the negative net asset value percentage change for all four funds, the estimated monthly number of distributions available has decreased even lower than the prior reported monthly distributions available. You can see that GOF started with a negative 11 and the NAV is down 3.7%, which represents an estimated negative 3 monthly distributions. Negative 14 subtract negative 11, that's 3 monthly distributions. And the situation's similar with all of them. So there's no clear winner in this category. And finally, there's final score, which is an extension of the fund's score based on the fund's performance since it last reported. And since the final score of 3 is higher than the other 3 funds, that category also goes to PHK. Now, I don't know if you've noticed, but I've been keeping score throughout this little review, and you can see that PHK has most of the shaded boxes, which makes PHK clearly the best positioned fund at this time, with GOF coming in second place. So as it stands at this moment, as it pertains to the title of this video, GOF versus PDI, GOF has the edge. Okay, so if we're here to compare GOF versus PDI, why are we also looking at the funds PHK and PDO? PHK and PDO, along with PDI, are all PIMCO funds, and they share an awful lot in common. All 3 of them have very high yields. All of them have very high debt to equities, and all have large running earning deficits. And up until recently, they all shared very high premiums. Another reason is because I'm hoping that comparing these funds side by side over time might give us a little glimpse of the future based on performance past. And this is what I mean. PHK is the oldest of all the funds that we're comparing today. Its inception date was in April of 2003, which is all the way back here at the beginning of this chart. Coming out of the gate, it was doing pretty good until the beginning of the crash in 08. The fund got smacked down hard. And because of its very high debt to equity ratio, it was able to climb itself back out of the hole quite a bit. However, it never quite recovered from its previous high prior to the crash before the market got hit again. And for the same reason, it was recovering at a reasonable pace, but never quite got back to its previous high until the market got hit again and PDI got smacked down once again, never quite getting back to its previous high before the market got smacked again, and once more never getting back to its previous high before the market got smacked again. and again not getting quite back to its previous high before the market got smacked again and never quite getting back to its previous high, and the fund has been in free fall ever since. Fast forward to 2012 when PDI started. As you can see in PDI's case, it bolted out of the gate pretty much just like PHK did. The market got smacked, but not nearly as hard as the crash in 2008, so it was able to not only get back to its previous high, but exceed it. And then the market got smacked again, and once again, PDI was able to recover back to its previous high. However, there's a catch. There's one distinction that separates PDI from PHK. In June of 2017, PDI began to use what is called an at-the-market facility, or ATM. Now, what is an ATM? The ironic thing about closed-end funds is that they're called closed-end funds, and the assumption is that a closed-end fund is usually closed to new investors, but nothing can be further from the truth. The fact of the matter is that just about every closed-end fund has a mechanism in which to bring new shares onto the market. This could be in the form of a rights offering, where a fund announces to the world that they're about to issue a whole bunch of new shares. And usually existing share owners get dibs at maybe a slight discount. In a lot of other closed-end funds, as you can see here from the GOF Statement of Owner's Equity, they currently have 119,342,000 shares outstanding. But in the line item above it, you can see that they have available to them an unlimited number of shares. Having at your disposal this ability to issue new shares whenever you need them allows you to raise additional capital for your fund without announcing it to the world, and in so being able to bring all these new shares to market without making a big whoop-de-doo about it has a much more calming effect on the fund's market price, as opposed to shouting it from the rooftops when you bring about a rights offering. Two of the methods that are available to a fund manager when they have access to an unlimited number of shares are shelf offerings and at the market, ATM, where the fund has a third party sell a specified number of shares on the open market, and then the proceeds are given back to the fund. This avoids a lot of havocs on the fund's market price and provides much needed cash flow for a fund to pay its distributions. Now, this ATM facility went into effect in the period reporting of June 2017. But it doesn't stop there, because they've been using this ATM facility every reporting period since. And the institution of this ATM facility just happened to coincide shortly after PDI's market price started to consistently trade at a premium, allowing the fund to benefit from a little markup on their net asset value price. And it appears to have worked too, because as you can see, during the next market correction, it was not only able to avoid PHK's continued decline, it was a significant contributor to the fund getting back to its previous high. And it was working pretty well until the great crash of 2020. And as you can see, just like PHK, because of its extreme high debt to equity and massive earnings deficit, has not been able to recuperate to its previous high. And just like PHK, it is now in continual free fall. Now, the reason I included all three of these funds, and if you follow along with me, tell me this doesn't make sense. PHK got off to a great start, and unfortunately, the great crash of 2008 happened and obliterated it. It was able to get a large portion of it back, but because of its high debt to equity and the accumulated earnings deficits, it wasn't able to get back to its previous high before the next market occurrence. And PDI started to follow in PHK's footsteps. It just seems that there are too many market events that never gives the very high leverage formula a chance to work in between corrections. However, the addition of the at-the-market facility, which kind of tweaked the PHK formula, seemed to be a big help during corrections, but ineffective when the market eventually crashes. I look at these three funds like PDI is today's PHK 2.0, and I included PDO. I think PDO is tomorrow's PDI. I could tell you that only time would tell, but I have a hunch that PHK still offers us some valuable insight as to where PDI might wind up. In September of 2015, which I can only assume is the first attempt by PHK to course correct, they had their first distribution cut in September of 2015 of 2 cents per share. And about every couple years after that, 2 cents more. Now, market conditions improved, but again, the fund never managed to get back to its previous high. And then lo and behold, there was another market correction. However, this time the fund seemed to have found a bottom, and it held until the crash of 2020. The fund managed to bounce back, but still not quite to its previous high, proving that distribution cuts weren't sufficient. But all hope is not lost. Another initiative that PHK embarked on prior to the crash in 2020 was debt reduction. You can see over here in July 2019 to January 2020, their attempts to start bringing down their debt levels. However, when the market crashed in 2020, it kind of put their debt reduction plan on hold because they had to go back to the well in July of 2020, and they increased their debt yet again. And then again in January 2021, and again in July of 2021. But beginning in January of 22, they started to get a little bit more aggressive with their debt reduction strategy, where they went from a debt to asset ratio of 42.7% in July of 2021 down to its current level of 20% in June of 2023. Now, I don't know how low PHK plans to go with their debt reduction strategy, but even if they just maintained at the current 20%, in addition to strategic use of their at-the-market facility, this fund could wind up being a model turnaround story for PDI to follow when it gets to this point. And one final comment on PHK before we move on to the comparison between PDI and GOF. As I mentioned earlier in the fund comparison portion of the video, PHK is the only fund out of the four that was able to cover its distribution for the most recent period ending. And not only for this period, but for the period before that, the period before that, period before that, and on and on and on and on, except in July 2019. Okay, here we are looking at the life of GOF and PDI side by side. GOF's inception date was back in July of 2007, and unlike the start of PHK, when it was reaching new highs going into the crash of 2008, GOF was started when the crash was already happening. And although such a significant drop so early in a fund's life may have been gut-wrenching to new investors, this uniquely positioned GOF to take advantage of falling asset prices on the way down and low asset prices while they were on their way back up. And unlike PHK, which never fully recovered to its previous highs before the crash of 2008, GOF not only recovered but exceeded its previous inception price. Now, as a consequence of good timing and good returns, GOF was actually raising distributions during this period of time. And not long after, GOF started its ATM facility, ironically around the same time PDI had its inception date, which ironically was not too long after the fund started trading at a premium. It makes sense, right? And from that point, they continued to rise in market price. They continued to raise cash from their ATM facility, and they continued to raise distributions until they didn't. For some reason, in July of 2013, GOF reached a distribution height of its current 0.1822 cents per share, and it hasn't had a dividend increase or cut since. PDI, on the other hand, in addition to its incredibly high yield, was also making massive special distributions. Long story short, with GOF's constant use of its at-the-market facility, halting the increases to its distributions, you can see that every time the market smacked down, GOF was able to recover. Even after 2020, it fully recovered. It's languishing now, and I would like to say that it's nothing to worry about because it's been in this position before. Problem is, the last time it was in this position was after a market crash. This time around, it doesn't have that excuse. Okay, we're almost finished. Before we wrap it up, we're going to address some of the things that will be ongoing concerns for GOF and PDI in the future. Distribution sustainability, volatility, premiums, fund flows, and warning signs, and then I'll close out the video. Now, to address the first issue, is the distributions for GOF and PDI sustainable? And the short answer to both is yes. Not too long ago, between the period of May 2021 and November 2021, GOF roughly doubled its capital position due to a recent reorganization among its sister funds. Similarly, in about the same time, PDI also had a reorganization among its funds, nearly tripling its capital position. I suspect that these massive increases are made in the hopes that the funds can prolong their distribution for an extended period of time, maybe over the next several years. This and the additional use of their at-the-market facility makes the short-term sustainability of their distributions a foregone conclusion. Now, regarding volatility, due to the excessively high debt-to-equity of PDI, you can expect bigger market swings in PDI, and in the event of major market moves, you can expect severe price swings in PDI compared to GOF. At PDI's high point here on February 10th, 2020, to its low point on March 30th, 2020, PDI's price took a negative 15.9% bigger hit to it than the fund GOF. On the flip side, if PDI does manage to recover after a big hit, getting in at the bottom would provide you with greater market returns in relation to GOF, as you can see here. Now, since both funds, GOF and PDI, heavily rely on their ATM facility to help make their distributions, premiums are going to play a significant role in the fund's ability to raise funds. PDI's premium has always been rather volatile, as you can see in the 6-month graph on the right, as opposed to GOF's, who's been fairly stable for a considerable amount of time until just recently. And over the past 2 months, both funds' premiums have taken huge hits, with GOF declining nearly 46% and PDI's premium declining a whopping 85%. If these numbers stay consistent, GOF is going to have a much harder time raising funds through their ATM facility, and PDI is going to have twice as much trouble. If these numbers stay consistent, GOF is going to have a much harder time raising funds through their ATM facility, and PDI is going to have twice as much trouble. Remember earlier in this video I mentioned that only roughly 10% of all high-yield closed-end funds cover their distributions with net investment income only, and that only less than 14% cover it with the combination of net investment income and realized gains. The actual numbers are currently only 10.12% of funds cover their distributions with net investment income, and only 12.88% with net investment income and realized gains. With so few funds covering their distributions from their two primary sources of income, you can understand why funds have to rely on creative terms of financing to continue to pay their distributions. And that's why I just recently introduced the new fund flows chart in Closed-End Fund Mastery. I added the fund flows chart so investors could see where funds are getting the cash to pay their distributions while capital was tied up in investments. Another reason was to give investors the ability to look under the hood of high-risk funds that rely on a consistent inflow of capital in order to meet their distributions. In this next illustration, I condensed the fund flows charts for GOF and PDI so that we can compare them both side by side. You can take the time to pause it and soak in all these numbers, but the reason we're here is to point out a couple things in particular. The first thing to notice is that both funds received enough inflows to cover their respective distributions. And you know this because because, as in the case with GOF, if you stack the net investment income with the realized gains, in addition to reinvested distributions, and then the use of their at-the-market facility, you can see that they've raised considerably more than the distribution amount paid out. And not in quite the same fashion, but the end result is the same. For PDI, you had a significant portion of the distribution met by net investment income. But PDI also had a realized loss, stacked with the reinvested distributions and then the use of their at-the-market facility. They easily met their distribution. The second thing to notice is that GOF's distribution consists of earnings and return of capital, while PDI's does not. In GOF's fund flows chart, you can see with this line right here, where the distribution from earnings ended here and the return of capital began here. You can also see that with net investment income and realized gains, that GOF just covered the earnings portion of their distribution while relying on reinvested distributions and their at-the-market facility for the return of capital portion of their distribution. PDI didn't claim any ROC, so all the money received from them was allocated to the earnings portion of their distribution, with the excess from their at-the-money facility to be carried over into future periods. Now, GOF ended the period with total inflows equal to 143.8% of their distribution payout, minus the distribution that left them with a net inflow of 43.8% to carry forward to future periods. PDI, they earned in excess of 88% over their paid out distributions to be carried over into future periods. Okay, now some warning signs that your future distribution from either of these funds might be in jeopardy. Number one, the fund's inflows no longer exceed the fund's outflows. Number two, the fund actually makes a very small distribution cut, as we witnessed in the case of PHK, where they made a small incremental cut in their distribution from 12 cents to 10 cents. Which actually isn't a very small cut, and even a cut in GOF's distribution from 18 cents to 17.5 cents represents a 3% cut, which isn't humongous, but it isn't small. And if it turns into a trend where a small cut is instituted every couple years or so, as is the case PHK, before you know it, you've lost more than 50% of your distribution. And number three, if your fund goes into the next major downturn, market crash or correction, before it recovered from the previous major downturn, there's a very good likelihood that when it comes out of that downturn, it won't recover to the previous high when it went into that downturn. Okay, that's going to wrap up this video. And as far as GOF versus PDI is concerned, for all the reasons stated in this video, and feel free to disagree, but the edge has to go to GOF. I want to thank you for taking the time to watch this video. I do plan on putting more videos out. I just don't know at what frequency yet. If you'd like to see more videos like this, please like and subscribe and click the notification bell if you'd like to receive notice of when a new video posts. If you would like to learn more about closed-end fund mastery as well as a free trial, there are links in the description below. Take care.